Well, good morning, good afternoon, and good evening to everyone, whichever time zone you're dialing in from this morning. Welcome. Now, if we haven't met, my name is Jonathan Wu. I basically manage the marketing team at Master Capital Group. I am a property investor and developer myself. Okay, now I also manage a professional networking group called Master Professional and Network. Now, if you are a professional in the property or finance industry and like to connect, network, or collaborate to add value to our investor clients, please do get in touch with me. We will put basically the information on the comment section, a bit more detail at the end of the presentation. All right, now before I invite our guests on stage this morning, I'd like to read out the disclaimer before anything else, if that's okay. It basically says that the information or the interview conversation this morning with Peter and Darren provided here is general in nature only, and it does not constitute the personal financial advice. So the information has been prepared without taking into account your personal objectives, financial situation or needs. So therefore, before acting on any of this information, you should consider the appropriateness of the information having regard to your objectives, financial situation, and needs. So we also advise that you consider these matters and seek appropriate legal, tax, and other professional advice. If you want to get in touch with us, feel free on the contact there, Master Capital Group, by email, or calling us on 1300-908-688. All right. Now, with that said, I'm going to invite our guests back on stage. Okay. All right, welcome, Peter. He's one of our first presenter.
Thank you, Jonathan. Welcome to everybody who's listening in, and appreciate everyone spending their time this morning and or this afternoon, depending on your time zone, where we're coming from.
Okay, good. All right, I'll talk to Peter in a little bit more in just a minute. Let me invite our second guest, Darren Jinkins. Welcome, Darren.
Thank you, Jonathan. Great to be here. Thanks, Peter.
Excellent. All right, we'll talk a little bit more about Darren in a minute as well. I also want to invite Tesla from Master Capital Group. Welcome, Tesla.
Hey, hi, thanks, Jonathan.
Okay, so Tesla will be helping out with the moderating the comments. So if you have any questions during the conversation with Peter and Darren, so please feel free to post it on the comments, and Tesla will attend to that. And also, we're going to have the Q&A in between the presentation and at the end as well. All right, if that's okay with Darren and Tesla, if you can just take a back seat for a minute, I will do the interview with Peter for a minute, and then I'll bring you back if that's okay.
Sure. That's fine, Jonathan.
Okay, thank you very much for that. Okay, good day, Peter. Good morning.
Good morning, Jonathan. How are you?
Good, good. Well, nice and beautiful sunny Melbourne day today, spring.
1st of October.
Yep, and we are still in lockdown, unfortunately, but it's okay.
Yes, true.
Yeah. All right, Peter, let's begin with this. If I can ask you to sort of maybe tell us a little bit about yourself, your team at Master Capital Group, and your services, if that's okay.
Sure. Well, Master Capital Group, we are an equity fund and senior debt position in the market. We have wholesale investors. We're licensed for wholesale investors, and we have an AFSL license that goes along with that as of back in 2015 when we first had the ASIC approval. We had made some changes last year, and as of this year, myself and Tesla are also responsible managers inside the license. A little bit about my background. I'm trade background from an electrician's point of view, but also then very hands-on on past projects, run multi-story buildings, and that's caliber of types of projects. And we invest usually we invest together with our investors in multiple projects, giving them risk-adjusted returns. Our staff, we have 8 staff in total currently which is well, there they go. So myself, obviously Tesla, John and Evan. John was 17 years at Lend-Lease, corporate accountant. Evan Elliott is a legal or a lawyer that used to work for Westpac, so we've got some really good skills. And Jonathan doing all our marketing. Tanya and Shona and Ella, my daughter, is also giving a bit of help during off-peak times, and currently at uni. So if you would like to, a little bit, there's about our business, but essentially we work with investors. We're trying to get the best returns we can, where they're risk adjusted, and they look for multiple opportunities to invest over different types of developments. From that, and that probably covers really our side of things, Jonathan. If that's well, I can read that. So appreciate the opportunity to talk to Darren today. I think it's going to be a little insightful. A lot of people get caught up with not getting enough tax advice, and something that I'm very strong believing in, getting the right professional people around us. And we've got a few questions here this morning that we'll go through.
Okay. All right. Thank you very much for that, Peter. So what we'll do now, we're going to invite Darren back on stage. All right.
Thanks, Jonathan. Thank you.
Welcome, Darren, once again.
Thanks, Jonathan. Thank you.
We're just teasing Darren earlier that he looks like a professional gamer with his headset on.
It is my son's headset, I must admit. It looks like a PS4 headset, if anyone's familiar with them.
All right, what I'll do is now I'm going to let Peter, who knows Darren best, to introduce Darren, as well as carry on with the conversation on property and tax. So take over, gentlemen.
Thanks, Jonathan.
Thank you, Jonathan. So we've better introduce Darren and Hughes O'Day Corridig. They currently look after a majority of our projects and or company accounting side of things. We have known each other for a number of years now, and I've used Hughes O'Day Corridig, or HOC, as a valued accountant for many years now. So I thought maybe before I go into the interview questions per se, maybe Darren, would you like to talk to you about what HOC and the services that you provide, some of the staff, and obviously one of the first questions will be around your self-managed super fund award last year and the year before for Lisa.
Yeah, no worries, Pete. Hughes O'Day Corridig is based in Essendon. We've got 3 partners, myself, Michelle, and Lisa. The business has been around since the late 80s. I've been working there since the late 90s. I've been a director since 2006. In terms of speciality, well, there's about 18 staff. Probably our main area of specialty is in relation to self-managed super funds. The other account, we do a lot of businesses. We do a lot of individual tax returns as well, but we've got a pretty good mix. The self-managed super fund is probably the biggest area, I suppose, where we're probably overweight in the self-managed super fund area. We've probably got about 300 super funds. In terms of awards, I mean, it's I'll have to actually read this out. There's a fair bit been happening over the last couple of years. We won the SMSF Firm of the Year out of a finalist of 4 in the Australian Accounting Awards. Lisa was a finalist in the SMSF Accountant of the Year and a finalist group of 5 at the same event. She was also a finalist at the SMSF Advisor of the Year in a field of 4 in the Women in Finance Awards. And she was also a finalist in the SMSF Advisor of the Year in a field of 7 in the IFA Excellence Awards. That was for 2020. For 2019, She was awarded the SMSF Accountant of the Year and finalist group of 10 in the Australian Accounting Awards, and she was also a finalist in the SFS Advisor of the Year in a field of 7 in the IFA Excellence, which is Independent Financial Advisors. So she's had a pretty good year, and she is very experienced in strategy and all the do's and don'ts of self-managed super funds. So it's been a pretty big year for the super section of HOC.
Yeah, look, it's great that you've got a great team and you've been building on that team even over the last few years with Lisa coming on board as well. So, I think the experience that you've got there and the fundamentals around how you've been working for the last years now set you in good stead to help further investors and or particularly in the growth of self-managed super funds. It's one of the largest growing areas. So, I'm a big believer of managing your own funds, and and hopefully we can have more clients come on board for both Master Capital and for HOC as well.
Yeah, I mean we sort of pride ourselves on doing all the work in house. It tends to be a lot of firms are offshoring a lot of the work. We feel more comfortable with doing it in house. For a number of reasons, we're employing people in Australia. And people have a little bit cautious about sending their information overseas. So we seem to be bucking the trend there. So.
Yeah, big believer in particularly for just compliance, even for our own AFSL side, is to make sure that we are compliant and releasing information out to third parties and that sort of thing is critical. Even when we have access to bank accounts and things like that, it's all in-house. Or here in Victoria, so it doesn't mean we can't operate.
And there's big penalties in getting it wrong too, Peter.
Yep.
It's just over the years with different situations, so you just got to be a bit careful. So, yeah.
Yeah.
Sorry, Pete. Should we get into the bulk of this, because we've got a fair bit to go through with Pete. So
we've got a fair few questions, but mainly, look, obviously it's around tax today, and it's an important. I believe it's one of probably the most important issues, and not because I'm just talking to Darren and HOC now. It's actually something that I personally feel really strongly about. Making sure you plan for the future and begin with the end in mind is one of the and those who know me well, that won't be the last time you hear me say it, because it is really important. So, with no further ado, the first question we have for you is what are the tax issues that are commonly raised in property transactions? Now, we've got a number of areas that we can go over. Would be around the main residence tax issues and the stamp duty, land tax. Obviously, there's some land tax regarding trusts as well, income versus capital, and GST margin scheme. So I might sit back and let you flow through those areas and see how we can see if we can add some value to the listeners as well.
Yeah, when you first asked me to do this, Peter, I thought, geez, property transactions. How long have we got? We could talk for a week about the different property transactions. But what I thought I'd do is I'd just do a couple of common scenarios that I sort of see. And I thought I'd just run through an example. You get let's say we've got a Mr. and Mrs. Smith. They're approaching retirement. They have insufficient retirement funds. Because they're a bit older, they didn't get superannuation support for the earlier part of their working lives. So they tend to have be asset rich and income poor. They really need to top up their retirement savings. In this situation, they've got an older home in a wealthy suburb, with a large block. You look at your Camberwells and your Essendons. They tend to have some fairly large blocks with a lot of cuts of smaller houses on them. The kids have left. So they're just there by themselves. One scenario, you can sell the home. Simple. Sell it for 1.2, whatever it may be, over $1 million. A lot of these places are worth, as you know, Pete, just from being in the property market. Some of those wealthier suburbs can demand some pretty big bucks, and they can buy a small apartment or a unit or something like that. There's plenty of apartments going up in the area. So they've spoken to some colleagues and accountants, and they've decided the best way to realise what their investment is to maybe get plans and permits for the property, and then maybe on-sell it to a developer at a premium. So developers love it when all the hard work with cancel has already been done, and they'll pay a premium for that. In this situation, because it's been their main residence, it's also probably purchased prior to capital gains tax coming in 1985. So there would probably be no capital gains tax on it anyway. So there's no tax, no capital gains tax on the main residence. In terms of changing the status of it, because they've only got plans and permits in place, it will still be a mere realisation of what they've got. So that won't change the tax implications of that. So that can be sold tax-free. In their situation, though, they're going to, well, if they purchase a new place, they're going to have to incur stamp duty. There is some concessions for pensioners with stamp duty, but generally it's the lower end. So if they wanted to buy back into their expensive neighbourhood, they might not get that exemption. In this case, they've become accustomed to where they live. They've got neighbours there. They love it. So the other alternative is to carve off the backyard. So they ultimately carve off the backyard, have a look at the size of the block, subdivide it. It allows them to stay with their neighbours. They don't need the backyard these days because it's getting harder and harder to maintain. So that could be a fantastic result. The only issue with that is you've bought that backyard into a taxable situation. So as we've spoken about before, Pete, in different situations, if you start on a profit-making venture, you've got tax implications. The first tax implication is because the plan is to construct a dwelling and then resell it, you've just brought it into a GST environment. So what happens, you do the subdivision, you engage a builder. Obviously, you've gone through the whole council permits and so forth. You engage the builder. You must register for GST. So as the builder sends the invoices into you, you claim all the GST back. So you actually get a refund of all the credits that you've paid to the builder, so the 1/11th. So that comes back to you. When it comes to selling the property, you need to charge GST on the sale. So typically it's 1/11th of the sale price. However, you can use the margin scheme, which Peter touched on before. Now, this can be quite tricky. Typically, if it's been a residential property at the point in time when the backyard was devoted to resale, you get it valued. So let's just say they said, well, you can't get blocks in Campbell. You probably can't get a block of land in Campbell. So the value of the block of land could be 800,000, say. And when I say the block of land, we're talking about the newly subdivided block of land. So with the sale price, if you sell the unit for 1.2 million, you basically say, well, okay, sale price 1.2 million. The value of the land when we devoted it to the scheme was 800,000. 400,000 divided by 11, which is, Pete? That's
enough.
So let's say it's 35,000. So there's 35,000 that needs to be paid to the tax office in relation to the sale. Now that's a hell of a lot better than 1/11th of 1.2 million. So that's a fairly big saving. However, there's one payment that needs to be made. Also, any profit on the sale of this property is now taxable. And now because we've jumped out of the capital gains regime, and now it's strictly a profit-making scheme. So there's no discount on sales. It's straight taxable. And presumably if it's in Mr. and Mrs. Smith's names, that profit will be split down to them. The profit will be basically the value of the land at that point in time when they devoted it to the project. So let's say that's 800,000 plus the construction costs, net of the GST, which they've got back, less the sale price. So whatever that figure is, that flows into their tax return for that particular year. What other notes did I make?
Maybe just on a point there, if they are doing a multiple project, so there might be maybe 2 units. When they actually sell, the contract of sale is really important. If they're doing it before the 30th of June, and or the 1st of July, it goes into different financial years. Maybe you just maybe touch on that, although that wasn't part of what we were going to talk about. But
yeah, thanks for the question with that notice, Pete. That's great. No, typically with if it's on capital gains account, it will be on the contract date. If it's on a profit-making scheme, it will be on the settlement date. That will be the relevant dates. Yeah. Yeah, I mean, ideally, if you can push it, if you can push the sale into the next financial year, then you can probably get 12 months delay of paying the tax, which is always, always handy. Yeah. They're the two. They're probably the two sort of situations where you get a lot of questions. I mean, there's different implications in relation to main residence. Now, we're assuming that Mr. and Mrs. Smith have lived in that house as their main residence for the whole period. If for example, they moved for a period and then came back, that may affect the main residence exemption, and there may be some sort of apportionment between non-taxable and taxable. So it's important to really dig into the facts and find out exactly what happened, where they lived, did they move away for a period, did they claim the other residence as a main residence? That means the main residence exemption comes off their main property. So there's all these things that you need to find out. If they did a development and they owned the property post CGT, then that back lot will go back to cost base. So if they paid, let's just say that they paid $80,000 back in the early 80s, then well, let's not say the early 80s because that would be pre-CGT, but let's just say it was the late 80s, for example, and they purchased the property then they subdivided the backyard. Well, they would have to apportion that original cost base across their main residence, which has the house on it, and the backyard. So there's all these market value valuations that you need to get and put it in place. Because if the ATO ever look at it, firstly, they'll ask for the valuation. And if they're not happy with the valuation, they can contest it and say, well, look, you've got maybe a favourable market valuation there. So these are all the little nuances that you need to just be a little bit careful of. So it really is a fact, for the accountant really needs to get all the facts together, line them up, do a timeline, and just make sure they tick all the boxes. Because it all, it's like it, you can tick, 90% of the boxes or 99% of the boxes, but that one box that doesn't get ticked can change the whole outcome, unfortunately. So I think we've gone through that. Have you got any questions in relation to that, Pete? Does that sort of make sense? I know we've sort of seen this sort of situation before, and you've come across it occasionally. We've spoken about it with different situations that have arisen with some of your projects.
Sure. Yeah. So we had some, around the stamp duty type and the State Revenue Office changing of ownership, whether once you make an application into council, it is deemed to be the ownership of the trust and we'll get into, because I've got some questions around trusts as well, which we'll come back to probably in the next section. But I certainly know that, when you're looking at, particularly if you're trying to do a joint venture with a landowner, keeping the land in their name and things like that is going to be important. And whether you set it up into a company, which is what we recently did in a subdivision we were looking after, that saved a heap of tax. And it's not about not paying tax. Pay tax where it's necessary and or where it's legally correct. Just make sure you're thinking about it prior to actually going ahead with that project, because as you've gone through just now, the terms that you're going through in from the ownership point of view, and what part of that ownership rolls forward as well. So and I'm just wondering,
that's sort of delving into the third part of it. I mean, with the original situation with Mr. and Mrs. Smith, they had it was just a mere realisation, so that's on capital account, so it's a capital gains issue, but then they get out of the capital gain on the basis that it's their main residence. If they don't get out of it on the basis that it's their main residence, because it's pre-capital gains tax when they originally purchased it, there's no tax consequences there. In the second situation, you've got a profit-making scheme. So they're doing it for, their intention is for resale. So it's not on capital account, because anywhere where the intention is to make a profit out of resale, it will be, you won't get your 50% capital gains discount. And then I suppose the third sort of area, if you like, is the full-on property developer, which sort of you're sort of dealing with, Pete, where you've got major projects, major building and construction and so forth, investors, and everything that goes with it. That's obviously that's treated as trading stock. So you purchase the land, you construct on it. It's all carried in stock. So it's like any other business, where it be a fruit business or whatever. You buy things, you carry them as stock, and then you sell them at the end, and that's treated exactly the same way. So, but that's sort of different again. So we can probably talk about the structuring of that, and I think the biggest area with that is just the whole structuring of those deals and how to get it right. And every one is different. As you know, Pete, we've had many discussions about what's the best structure for this, and unfortunately, there is never the perfect structure. There will be some that tick some boxes, and other structures will tick other boxes, but there's none that tick all of them, unfortunately.
Yeah, but maybe before we go on to the structures side of things, maybe we go back to Tesla for if there's any question and answers for any of the audience that are listening. So if I can bring back Tesla on board.
Sure. Okay. Thanks, Peter. Well, yeah. And actually, we do have some questions, but however, I think we did actually answer some of them. However, probably some of the questions that I would like to show you, what you want to ask you is, Darren, is there any financial planner actually in-house?
Yeah, we have a relationship with Prime Financial, so they do all of our financial planning. It's there's a very fine line between what we can say and what we can't say as accountants. So as accountants, we can sort of talk about general groups, if you like, property, shares, and so forth. But in terms of actually telling someone to buy BHP and buy CSL and sell this, accountants aren't allowed to do that, so we have to refer that off. And just for clarity, I'm not saying buy BHP or CSL.
Okay, that's fair enough. So it is something. Okay, so yeah, I think what we will we do have actually, you basically touch a little bit on that, if a parents actually sell the house to the kids, is there any capital gain tax, actually any exemptions, what do you think about that?
Well, it depends what the house is. Now, if the house is the parent's main residence, then they can sell it to the kids, no problem, because it's and as I said before, you need to be careful with that main residence. How long have they lived in it? Has it been their main residence for the whole period? But let's assume that's the case. Then they can sell it to their kids, and there's no tax implications for the parents when they sell it. So there's no capital gains. There will be stamp duty still. And look, it's a bit hard to talk about stamp duty to the full gamut, because it's a state-to-state thing. I know Victoria will certainly capture that for stamp duty. Other states may have exemptions, but you just need to be careful, or be aware to check the local jurisdiction with stamp duty. But let's say it's a holiday house, for example. So the parents own a holiday house, and they decide to sell it to the kids. Well, that will have CGT implications for the parents,
Okay.
even if they decided to gift it to the kids, because it is a related party transaction and it's sold for nil consideration. The ATO will deem that it is a sale at market value. So even if they wanted to give it to the kids, as soon as the property transfers, that will trigger a capital gain at market value. So based on the market value at that point in time and what the parents bought it for, that's how the capital gain is calculated. And that capital gain will go into their tax returns, and they'll be paying tax on it, even though perhaps they haven't received a cent for it.
I see. Okay.
So you just need to be, again, you just really need to get to the facts Yeah, I mean, there is, if it is a holiday house and it hasn't been rented, well, arguably you can capitalise all of the costs. So if you've had it for, say, 15 years, you can go back and add up all the council rates and the water rates, all of those holding costs can go on to the cost base to reduce that capital gain. But again, that just comes back to record keeping.
Okay. Thanks, Darren. Yeah, I think that's all for me. I think we're back to you, Peter.
Thanks,
Sure.
Tesla.
Thanks, Tesla. Good questions there, and if there's any further questions, please send them through to Tesla, and he will bring them up at the end of each questions that we're going through now. So the next one that I like the most is there a preferred structure? Now, I know it's a loaded question, and we've had many different conversations. It's also about asset protection from when I look at it from a project point of view, making sure the SPV or the special purpose vehicle, the company is set up correctly, and or whether there's a trust involved. So maybe I might, I'll throw that open question to you, Darren. It's there's a few, obviously a number of different ways you can structure it. So over to you.
Okay, well, the short answer is no. No, look, it depends. Again, you've got to look at the circumstances of each situation. I mean, is it just family members? If it's a family group, you might be able to get by with a discretionary trust. But certainly, if I was going into a property deal and there was a number of other people, a discretionary trust wouldn't be satisfactory. I would want a fixed entitlement. So if I tip in 100,000 and the deal is everyone else tips in 100,000 up to $1 million, well, I want a fixed 10% of the outcome. So that effectively means typically a unit trust or a company. Advantages of companies is, well, firstly, they're fairly simple. The shareholding underneath reflects your equity in it. So again, if it was a company in the same situation, I would expect maybe 100 of the 1,000 shares or 100,000 of the million shares, and that would give me a fixed entitlement to all the 10% of the profits and the capital of the company, assuming we're just talking sort of ordinary shares. The advantage of a company is now typically with a development, you'll go and buy the property. Perhaps you've got borrowings, perhaps you don't. You tip in the construction costs, again, whether that's money contributed by the shareholders or it's borrowings. It gets the development gets constructed. You sell all the property, and typically what happens is you're making losses for the first few years because you've got overhead, you've got accounting fees, you've got holding costs for the property. A lot of the costs, the construction costs and so forth, will go into your purchases. So it would be in your cost of goods sold. And until you start selling properties, that cost of goods sold will just roll over as trading stock from year to year until you get to the point where you sell down the property. So you've typically got small losses in each of the years. Then as you start selling off the properties, you've got some fairly substantial gains. Well, hopefully anyway, that's the plan. You've got some fairly substantial gains. And the benefit of the company here is you can decide to pay tax on those profits at the corporate rate, and then maybe declare dividends over the next 2 or 3 years. I mean, that said, you can declare a dividend in that particular year and clear all the profits out. But at least you've got a bit of flexibility in terms of maybe paying dividends out over a few years to try and minimise the tax-free thresholds. Because obviously, if you've made $500,000 on it as a shareholder, you don't particularly want that dumped into 1 year. From a tax point of view, you'd be better off with, is it 160, 170,000 per year. It's a lot more manageable than 500,000 being dumped into your tax return. I suppose the disadvantage of a company is there's no capital gains discount. So if there's an intention there to maybe build maybe 10 units and you're going to keep 2 or 3 of them and rent them, normally you would get a 50% discount when they were eventually sold, maybe in 5 or 6 years. Now, a company won't get that 50% discount. So hence where unit trusts come in. So they can access the capital gains provisions, which means any profit on the sale of those particular apartments or units will get a 50% discount, because they were built not for resale, they were built to rent. But again, the disadvantage of the unit trust is when those other properties are sold, so the apartments or dwellings are sold, all of that profit will have to be distributed out in that particular year, which may cause some tax problems. So that's where it's very clear. You know, you've got to be very clear right at the start. What are the intentions? So you can structure it on that basis. So if the intention is to maybe hold one or two of the apartments, maybe a unit trust is a better structure. But I mean, the problem is a lot of the times people get to the sales, and then for whatever reason, maybe the market's dropped a bit, and their intentions change. So they might say, look, we intended to sell each of these for 450, but we're only getting, the market is sort of indicating 350. So they say, rather than sell now, what we'll do is we'll rent, and that causes all sorts of problems. But unfortunately, there's not much you can do about that. You can really only go based on what the original plan was.
Yeah, and look, you know, there's a few things that from a private or privacy point of view, if it happens to be in a unit trust, for argument's sake, it'll be a company as trustee for the unit trust. However, if people are trying to keep their wealth and or their name, probably not so much their wealth, but their name out of the public light, if anyone can do a company search, you know, through ASIC, and it'll show their shareholdings in each particular company. Where if it's in a trust, the trust is not displayed anywhere, and so it's only the private, the people who are in the unit trust actually will know who is in the unit trust. So that's also a disclosure point of view. So, you know, a lot of investors want to keep that information relatively quiet. You know, they're not all investors want to be known to be investors. So the other sort of structure that you see occasionally is joint ventures, where it might be a situation, say, for example, Pete, where you've got, say, a block of land of, I don't know, whether it be worth 500 or whatever the value is, and you come to me and say, look, I need someone to tip some money in, so to fund the construction. So we form a joint venture. You contribute the land, I contribute the cash. But we also say, okay, we're building 4 units. You keep one, I keep one. You can put a partitioning agreement in the joint venture. So when we finally complete the units, there won't be any stamp duty when it transfers. Your unit transfers to you and my unit transfers to me. But you need to have that partitioning agreement right, and you need to indicate exactly what unit, you know, you're going to be taking. It gets a bit messy. And we've had a situation before where there's been partitioning agreements, and they said, okay, well, I'm going to take unit 1 and you're going to take unit 2. But then we find that there's 5 or 6 other apartments, and people come along and say, oh look, we want the units, we'll pay a premium for that. So then all of a sudden they take our units, and we're left with the apartments that are a bit harder to sell. So that's where things can get a little bit pear-shaped at times. But I guess it's down to begin with the end in mind, you know, and if you know, work out what you want, how you're going to, you know, dissolve that joint venture. And, you know, even just recently, you know, setting up a company on a recent subdivision, the same sort of thing was, you know, we actually saved, you know, after we got the right accounting advice, also was about how to, you know, best bring those funds in. And if the unit trust, you can have mezzanine or debt levels come into the company, and they're just in and out. So the actual company pays for those those loans, where again it's not disclosed. There might be a caveat on title, but other than the caveat, it'll be a caveat on behalf of the entity that owns the title. So we probably go. So I think that, you know, look, there's all lots of different ways, and I think that's probably, you know, this is just highlighting, you know, we could probably spend, and those who know me well, I could probably spend a lot more time on each one of those topics, but this is really a general overview, and, you know, we're not trying to, you know, give people information that is relevant that they can then come back and go, actually, in this case, Darren knows what he's talking about. They're a good firm. They've been around a long time, and this is what they specialise in. So, I think that is there any other maybe Tesla? Can we just have a quick check? We're probably running a bit behind by the look of it.
Sorry, can I just make one comment? Sorry, Pete. Just sorry to interrupt, but in that situation before where we spoke about you owning the land and me wanting to tip some money in to do the construction, if we decided to maybe set up a company and then transfer the land into the property, into the company, I should say, the transfer of land will trigger a stamp duty impost. So if it's worth $1 million, we're paying $50,000 in stamp duty, and ultimately you've got the same owners. So these are the sorts of things that you really have to consider, because they can be costs. I mean, that said, that still may be the best way to do it. But there's little traps you've just got to watch out for. It's not as easy just shifting property around between structures. So,
sure. All right. Well, given our time basis, we're probably a little over time by now, but maybe if we just go on to the next, the tax implication when purchasing a new versus existing investment property. So covering off some items like negative gearing, positive gearing, tax depreciation or tax deductions, and land tax and main residence. I know we covered a little bit of that earlier. If you want to make some comment, you go back to the question and answers if there's any further questions from the audience as well.
Yeah, look, probably the big thing with purchasing between an old existing property and a new property is they've changed the depreciation rules of late. Back in the 80s, they brought in the building allowance, which basically gives you a 2.5% write-off of all the construction costs. So that lasts for 40 years. So if you're buying an older property, and let's say it was bought in the late 80s, well, you're running out of building allowance. So you might get a few years based on when the property was constructed. You may not get anything. With a new property, you've obviously got, if it's built today, well, you've got 40 years of building allowance that you can write off. So that's effectively 2.5% of the construction costs you can get a deduction for. Over the last couple of years, and let's just run through an example. Let's just say I bought a property off Peter that he'd owned for a number of years. I buy the property prior to 1 July 2017. I could organise quantities if I had to go through the property, and he would walk through and he'd say, okay, what's Peter got here? He's got a dishwasher, he's got hot water service, he's got garage doors, he's got garage door motors, he's got light fittings, he's got some fixtures and fittings, and all this stuff could be depreciated. So I could effectively, even though Peter had written it off when he was claiming it, I can get a value placed on that, and I could depreciate it again. Now, basically, they knocked that on the head from the 1st of July 2017, I think. So the only thing that I could get from Peter now, if I purchased his property today, is anything that's left on the building allowance, which is the 2.5%. So all of those hot water services and that, they're written off. So I can't claim anything unless I replace the hot water service or I replace the dishwasher. Then I can get a claim. Now that's been a change over the last couple of years. So that's obviously attractive from a strictly tax point of view to buy a new property. And I think that's why the government is probably pushing for new construction, and certainly to kickstart the economy these days. Also, in relation to that, the real gains to be made from rental properties is from the capital growth. I mean, generally you're looking at, certainly in Melbourne, between 3 and 3.5% return. That's gross. Then you've got to take out your council rates, your water rates, interest, insurance, repairs and maintenance. So from an income point of view, it's a pretty crappy return. The trick is still to pick the right area where you're going to get the capital growth.
Yeah, and I think it's partly, and we'll probably have to wind this up, but it's also about manufacturing growth as well. So the things that we look for is not just buying a house and renting it out. We'll actually look to buy a house or a block of land, subdivide it, build some units or townhouses or whatever on it, and manufacturing the growth. That's where the returns are higher. There is risk involved in it, so it comes down to that. But it's about mitigating risk and what you're doing about that as well.
Yeah, absolutely.
I might just switch over to Tesla and see if there's any other question and answers. Tesla, you there?
Thank you, Peter. Okay, so hey, Darren, from what our one of our audience, it showed that actually we from the actually state revenue, office point of view, how does the stamp duty impact on the structuring? Any ideas, any comments on that?
Oh, stamp duty impacts on structuring in the respect that if you've got perhaps a property that's already owned, there'll be stamp duty implications if you try to move it into a preferred structure. So it really becomes a number crunch. If you transfer it out of, say, let's say Peter's got a property in his own name and he wants to develop it. So the ideal situation is to maybe transfer that property into a company. We get investors to tip in for the development. There'll be an issue with the transfer from Peter to the company. So you need to sort of factor that in and work out then whether it's worth actually doing it that way, or is there some way to maybe do it in Peter's name, or it just throws up some issues. The stamp duty, look, certainly in trusts, certainly in trust you've got some flexibility, but again, if there's unrelated parties involved, it needs to be some sort of a company or unit trust. But again, transferring property between entities is going to trigger that stamp duty.
I see. Wow, I had to learn a lot today. Okay.
Yeah.
We have another question, from one of our audience is saying that is there this is actually estate or any inheritance is subject to CGT?
Yeah, well, that's deceased estate. If someone passes away, you've effectively got 3 years where you can lodge an estate tax return and the person is treated as an individual. So it'll just be exactly the same as the person. However, it's in the name of an estate and they get taxed as an individual. So if that person passes away, they've got their main residence. If it's sold in the estate, there's within the 2-year period, there's no tax on it because it was their main residence.
Okay.
If they owned a rental property, you need to go back and check to see when it was purchased because it will be the same cost base. So let's say the person that passed away, they purchased a property in the mid-90s. We would need to go back and find out what the cost base of that property is, and then return a capital gain in the estate tax return. If the property, for example, gets passed through to one of the beneficiaries, they inherit that cost base from the 1990s. Now, this is where it gets a bit tricky because sometimes old grandma or grandpa have no idea where the records are for that purchase. So, the other thing I'll make a comment with that, and that works the same for shares as well. If the property or the shares were purchased pre-capital gains tax, the cost base becomes the value of that at the date of death. So if we go back to Mr. and Mrs. Smith, and let's just say that was a rental property that they'd purchased in the early 80s, if they passed away, the kids would need to get a value of the property as at the date of death, and that would then form their cost base. So you've got to look at it whether it's pre or post CGT. The proceeds of superannuation that will be taxable to non-dependent children. So if the kids are, let's say all the super has been left to the kids and they're non-dependents, there'll be a tax on that at sort of 16.5 from memory. But yeah, we could probably spend another half an hour.
There's one question actually, for my knowledge, is kind of like what happened if there's a developer, he bought a piece of land and then he passed away and then so on and so forth. What will happen then when they go to development? Will they be subject to CGT also?
Well, it depends if it's in his own name or if he purchased it in a company or a unit trust with other people. it would probably just have to run its course, the development, I suppose. I assume that there's other people involved. Depends on the scale of it, I guess. If the development was in his name, I guess the executor of the will would probably have to just keep going with that development, or make the decision to sell it off to someone else.
I see.
Yeah, it would form part of the estate if it was in their name. Yeah. Okay. That's what I mean, though, Tesla. A lot of these, every situation is different, and it throws up different,
That's why we need you. Thank you, Darren. Well, I think that's all the questions I have.
Okay. Well, thank you, Tesla. Appreciate that. I think we'll go on with Jonathan with a bit of a wrap up in terms of. But if anyone has any questions, feel free to contact Darren and I, or any of the team that we have. There is Jonathan. You're back. Would you like to wrap it up and?
Yes, thank you very much for that. That was a great presentation, by the way, and Q&A. Now, sorry, we can't get to all the questions that you might have, but anyhow, you can get in touch with Darren or Peter, and I'll just flag the contact details on the screen. Either capture that on your computer, or just use your phone camera and scan the QR code there, so you get the contact details. So again, do get in touch with Peter or Darren. Now, I believe also Tesla will post the information on the Master Professional Networking Group link in there as well. You want to get in touch with me to be part of that group and add value to our investor clients. That would be appreciated. Also, I think lastly, before we end, we do have the feedback form. If Tesla can help post that on the chat as well, I will appreciate that if you can provide us with some feedback on today's webinar. I'm sure there'll be more webinars coming up. We certainly want to improve on that and getting better and add value to your portfolio of your journey in your property investment. Now, saying that, actually, just a quick announcement. Next week, this is just off the cup, we do have another webinar coming up with Peter. He'll be talking about the property finance, so that'll be very interesting. So stay tuned on our social media post, as well as the email invitation is coming to you sometime tomorrow. Together, the presentation will be with Vincent Choi from Architects. He'll be talking about design optimization. So that's a very interesting topic. So stay tuned for that. That'll be for next Thursday. All right. I think now we now come to the end of it all. Once again, thank you very much, gentlemen, Peter and Peter and Darren for presenting and doing the interview, and Tesla for helping out with the comments. All right. Any last word, guys?
No, good. Thanks, Jonathan. Thanks, Tesla. Thanks, Pete.
Cheers. Thank you, guys. Look, I really appreciate it. It's something that property, obviously, something that I love. Investing is something that I love, and combining them all with good people and how we're all working together. Doing something like this is actually sharing with our clients as well. So, really important on a personal level. But thank you very much.
Sorry, people, you left out tax. You don't love tax.
Well, I do actually. Because I was looking on Saturday night. If you actually want to be true, I was looking at the ATO website on something there that just trying to understand better. Whether it's legal or tax. I'm always interested in it. So. Yes.
We'll leave it at that.
Okay. All right. Oh, that's
thanks, Jonathan. Thanks, Tesla.
Wrapping it up. So, well, we just want to say, well, once again, have a good morning, have a good afternoon, and have a good evening, whichever time zone you are dialing in this morning. So, with that said, stay safe.
Okay. All the best.
Thank you.
Thank you.